Well, folks, inflation is falling much faster than we expected, but the stock market does not seem to care at all. We recently got the CPI data, which came in right in line with estimates of around 6%, and the business-related PPI data that just came in way below estimates at 4.6% and actually declining on a month-over-month basis. However, the recent banking rout set off by Silicon Valley Bank is resulting in more fears around the credit market, which seems to be spooking markets more in the short term, especially with what we've seen play out with Credit Suisse. So, how exactly is Credit Suisse going to affect the US stock market, and what are the Treasury bonds telling us about how the Fed will cut rates at the end of this year? Those questions are exactly what I want to address in this video, but as usual guys, before we get into it, make sure to drop me a thumbs up and hit that subscribe button if you haven't already. So to start things off, let's understand what data has shocked the market today. PPI came in at 4.6% versus an estimate of 5.4%. This is the producer price index, which obviously shows us the final demand costs of goods, meaning this is the price that businesses are facing from their own input material costs. This pricing has collapsed since June of 2022. We're sitting at almost 12%, and now it's sitting at 4.6%. This is what a declining inflationary period looks like. CPI, although is coming down, PPI is falling faster. And as we all know, PPI does tend to lead CPI in the short term because obviously businesses have the ability to pass on their lower costs to consumers. And although right now we're not necessarily seeing that play out, chances are it will play out over the next few quarters. And why exactly do I think that? Because as you can see, PPI in yellow has always been a magnitude derivative of what CPI has been doing. CPI includes a lot more things than PPI, whether it be household expenditure, oil and gas, or food. But as you can see, whenever PPI tends to collapse, CPI always follows over the next few months. At least it has been the case for the past 10 years. And when inflation started skyrocketing in early 2021, it was the producer price index which skyrocketed in January, followed by the CPI in February. And right now we are seeing the opposite play out, where PPI is now accelerating to the downside, but CPI necessarily has not caught up to that rate of deceleration. Now trust me, I see a lot of people in disbelief about this idea that inflation is falling when prices for groceries are still at near all-time highs. I hate to break it to those folks, but inflation takes a really long time to wither through the economy. It's going to take at least 3 to 4 quarters for you to see your grocery bills fall if CPI is falling today. That is just how the economy works. Food has historically been the most sticky form of inflation, with butter, margarine, eggs, and fats and oils being some of the leaders of the February 2023 CPI report. Instead, what we have seen is we are seeing declines in goods and energy for the first time in 24 months, with televisions, used cars, and major appliances leading to the downside. Because as you can see, CPI is an index, not a percentage. The number that you see on the headlines is just a year-over-year percentage of what this index has done. And as you can see in 2021 and 2020, that index started skyrocketing at a very accelerated rate, which resulted in the year-over-year change to be very high. Over the long term, CPI follows GDP growth. It always goes up. It barely goes negative in extreme scenarios like we saw in 2008. That's when you get the negative percentage change year over year. But right now, over the long term, the Fed has a 2% growth target, meaning this index is going to still go up, except it's just going to go up at a rate of 2% per year, not 6%. So for you to expect the prices to go negative to really count as disinflation is a very broken myth. Instead, what we should be focusing on are some of the key components of CPI, which are still showing lots of strength. As you can see, the biggest component is shelter and rent inflation, which just hit an all-time high of more than 8%. What's most likely happened in the economy is that as mortgage rates have gone up, households and landlords have skyrocketed their owners' equivalent rents to make up for the difference. I don't know if this is a short-term phenomenon or a long-term phenomenon because I have not lived through a time like this before, but it goes to show you that overall inflation categories are starting to fall and that the headline number is simply being led by smaller components that are typically more sticky and related to the real estate market. Where the collapse of a major technology bank, a liquidity crunch, and the fact that 60% of the CPI report was driven by shelter, I am sure the Fed is looking at this in a very detailed manner to decide how they're going to raise interest rates for the rest of the year. Because obviously we expect 2023 and 24 to be near the terminal interest rate hike. And this is where things get really interesting. After the collapse of SVB earlier this week, we saw yields invert at a rate that we have never seen in the history of markets. Markets are all of a sudden pricing in the idea that the Fed is going to cut interest rates by more than 100 basis points by the end of this year after hiking in June and in May. Typically, when inflation is going up, the 2-year and 10-year yields go up, because they're trying to price in the fact that the Fed will probably increase interest rates more and treasuries will become more attractive to most investors. But what happened on Monday, the day after SVB collapsed, is truly fascinating. The 2-year treasury yield fell by more than 5% in one day. It actually is now below the Fed funds rate in blue for the first time since 2020. This is obviously an historic move in a yield that is so very well tracked by most investors. Either this showcases the idea that the market is understanding the damage the Fed has already done, or this is a signal that the terminal rate is much closer than most investors are pricing in. Because it turns out the 2-year yield had its worst 3-day return since 1985. Which happens to coincide with the time that the Fed peaked its interest rate hikes coming out of the 1979 recession. This is something we have not experienced in almost 40 years, and something I think investors should certainly keep in mind, because obviously it's very easy to get lost in the insane hiking we have seen throughout 2022, which leads many people to rush towards bonds at a time when they're probably not the best pick. And to put into perspective just how volatile markets have been after the SVB collapse, as you can see on March 8th, this is how the implied overnight rate and number of hike curve look like for the rest of the year. By the time SVB collapsed on March 13th, this is what the chart looked like. This is why the 2-year and 10-year yields collapsed, and this is also a signal to the Fed that maybe they have done one rate hike too much, as one of the biggest startup lenders has collapsed. And as we all know, startups and IPOs were the biggest contributor to inflation throughout 2021 and 2022. But as usual, guys, that is just my take on the situation. Let me know what your thoughts are on the situation of the markets and how inflation has persisted. Are we near the bottom, or is this a time to sit on the sidelines with cash? Let me know your thoughts down in the comment section below, and I'll catch you guys in the next one. Take care.